Welcome to Market Focus. Today we're discussing the best strategy for option trading, how you can manage your risk and aim for steady gains in the options market. If you're new here, we explore trading, investing, and personal finance tips to help you make informed decisions. In this video, we'll reveal one of the best options strategies for balancing risk and reward, along with some essential tips for success. Quick disclaimer. This content is for educational purposes only and not financial advice. Let's jump in. Before we dive into the strategy, let's quickly touch on options basics. Call options give you the right but not the obligation to buy an underlying asset at a specified strike price before expiration. Put options give you the right but not the obligation to sell an underlying asset at a specified strike price before expiration. Options have a cost known as the premium, which is influenced by factors like the underlying's price, volatility, and time to expiration. As expiration nears, time decay or theta accelerates, eroding the value of long options if the underlying fails to move favorably. Buying an option, whether a call or put, can yield significant gains with a relatively small capital outlay, but there is a high risk of total premium loss if the trade goes the wrong way or if time decay eats into the option's value. One popular strategy that limits risk and offers a solid risk-to-reward profile is the bull-call spread. Here's how it works. Buy a call option, typically in the money or at the money to have a higher delta. This is your primary bullish position, giving you the right to buy shares at the strike price. Sell a call option, typically out of the money with a higher strike price. This offsets part of the premium cost and reduces overall risk. It also caps your potential profit at the short call's strike price. For example, let's say the underlying stock is trading at $100. You buy a 95 strike call for $7 and sell a 105 strike call for $3. Your net debit is $4, which is the $7 premium paid minus the $3 premium received. Your maximum profit is the difference between the strikes, which is $10, minus the net debit, resulting in $6. Your maximum loss is limited to the $4 net debit if the stock stays below 95 by expiration. The bull call spread benefits if the underlying stock moves above your long call strike, but you only need it to rise enough to recoup the net debit for the trade to be profitable. Your risk is limited to the net debit, and your profit is capped at the short call strike. Now you might ask, why not just buy a single call option? The short answer is cost and probability, lower cost. By selling a higher strike call, you reduce the net premium you pay. This makes it easier for the trade to become profitable. Limited risk. The most you can lose is the net debit paid, which is often less than the cost of a standalone call. This can be especially helpful in volatile markets. Higher probability of profit. Because your net investment is smaller, the stock doesn't need to move as far to make your spread profitable. Although profits are capped, this trade-off can be attractive for consistent gains. Flexibility. You can adjust strikes based on your outlook. If you're moderately bullish, choose strikes closer to the current price. If you're extremely bullish, you might select further out-of-the-money strikes for a cheaper debit and higher potential profit range. No strategy is foolproof, so let's cover risk management and best practices. Position sizing. Only risk a small percentage of your total trading capital per trade. 1 to 2% is common. This ensures you can withstand losing streaks. Set a profit target and stop-loss plan when you'll take profits if the spread moves favorably. Know your exit strategy if the market goes against you, such as closing the spread before it hits max loss to salvage some premium. Time decay awareness. Options lose value as expiration nears, especially for the long call in this spread. Choose an appropriate expiration date with enough time for the stock to move, but not so long that premiums become excessively expensive. Market conditions. A bull call spread works best in a moderately bullish environment. In extremely volatile or uncertain markets, you might consider other spreads like an iron condor or a vertical credit spread, depending on your outlook. Let's do a quick chart analysis example on a hypothetical stock. XYZ Corp. Current price $120. Support and resistance. Support around $115, major resistance at $130. Technical indicators. The stock is trending upward. 50-day moving average is above the 200-day and RSI is in bullish territory. Trade idea: buy the $115 call, maybe $6 premium. Sell the $125 call, maybe $2 premium. Net debit $4 max. Profit $125 minus $115 minus $4 equals $6. Break even $119. Strike plus net debit. If you believe XYZ Corp will reach at least $125 before expiration, this spread could be a viable strategy. Always confirm your thesis with both fundamental and technical analysis. And that wraps up our look at one of the best option trading strategies, the bull-call spread. It's great for traders seeking a balance of risk and reward in a moderately bullish market. If you found this video helpful, hit that like button and subscribe for more trading tips and strategies. Let me know in the comments if you have any questions or if there's another strategy you'd like me to break down. As always, trade safe, and I'll catch you in the next video. Thanks for watching. Subscribe and ring the notification bell so you never miss an update.